Right now, Amazon stock is trading live at $247.39, surging an incredible $24.53 or just over 11% on massive volume. This isn't just a strong day, this is a market-shaking validation. Just yesterday, the dominant narrative surrounding Amazon was one of concern, of a high-cost behemoth that was lagging, the worst performer in the Magnificent Seven tech cohort, a company seemingly fumbling the artificial intelligence ball that competitors like Microsoft and Google were carrying for touchdowns. The expectation was that AWS, its profit engine, was slowing down, losing ground, and that the company's massive spending on new AI infrastructure was a drain with no clear payoff. Today, that entire expectation has been completely shattered. The reality, delivered in last night's third-quarter earnings report, is that AWS just re-accelerated its growth to a pace not seen in 11 quarters. The AI narrative, almost overnight, has flipped entirely positive, and Wall Street is in a desperate scramble to catch up. For months, the common ground among investors was that Amazon was stuck. You'd look at your Fidelity or Schwab Intelligent Portfolios account and see Apple stock and Tesla stock holding their own, or Nvidia stock setting the world on fire, and then you'd see Amazon just treading water. The belief was that its cloud business was maturing into a slower growth utility, and that its e-commerce side was a low-margin logistics nightmare, constantly battling consumer spending headwinds and regulatory threats. People engaging in self-investing were questioning if the growth story was over. But this is the critical disconnect between the surface-level story and the operational reality. The deeper truth is that Amazon isn't just a retail store. It's a duopoly of two incredibly high-margin, high-growth businesses, AWS and advertising, bolted onto the world's most sophisticated logistics network. And last night, both of those high-margin engines just hit the accelerator. Let's break down the numbers that are causing this explosion because they are stunning. The company reported earnings of $1.95 per share, absolutely crushing the $1.56 that analysts had forecasted. Revenue came in at $180.2 billion, clearing the $177.75 billion expectation. But the headline number, the one that has changed the entire conversation, is from Amazon Web Services. AWS revenue didn't just grow, it re-accelerated, surging 20.2% year-over-year to hit $33 billion. For context, this is its fastest growth rate since 2022. This single data point obliterates the AWS is falling behind narrative. CEO Andy Jassy didn't mince words, pointing to strong demand for both core infrastructure and new AI services. In fact, he specifically called out a 150% sequential boom in business for Trainium, Amazon's own custom AI chip. This proves they aren't just a customer of Nvidia stock, they are a core AI hardware and platform player in their own right, and that investment is now paying off. The financial power of AWS is staggering. That $33 billion in cloud sales generated $11.4 billion in operating income. That's a 34.6% operating margin. Think about that. While many are fixated on the brown boxes on porches, this division is printing cash at a rate that funds the entire company's future bets. But the good news didn't stop there. The other high-margin giant in the portfolio, Amazon's advertising business, also accelerated. It grew 24% to $17.7 billion. This isn't a side hustle. Amazon's ad business is now larger than the entire revenue of many S&P 500 companies, and it's growing faster than its main competitors. So the two most profitable parts of the company are both speeding up simultaneously. This is the reality that has investors on platforms from Robinhood to Interactive Brokers hitting the buy button. Now let's look at the retail business, because there's a nuance here that most are missing. On the surface, the North America segment operating income looked weak, falling to $4.8 billion from $5.7 billion last year. This is what bears would seize on. But the reality buried in the report is that that number included a massive one-time $2.5 billion charge for a legal settlement with the Federal Trade Commission. If you exclude that non-operational charge, the North America segment's operating income would have been $7.3 billion, a massive year-over-year increase. This shows that all the work on regionalization, logistics efficiency, and robotics is dramatically improving the profitability of the core e-commerce operation. The international segment also swung to a profit of $1.2 billion. So across the board, cloud, advertising, and retail, the operational performance was exceptional. The company also posted a massive $21.2 billion in net income, but it's important to note the reality behind that figure. It was heavily boosted by a $9.5 billion pre-tax gain from its investment in the AI company Anthropic. This is fantastic as it validates their AI strategy, but it's the operational strength in AWS and retail margins that provides the durable foundation for this rally. Many investors use a variety of investing sites or perhaps a SoFi Invest account to manage their portfolios, and they've been trying to figure out Amazon's place. It's not just a consumer stock. It's not just a tech stock. It's an infrastructure, AI, advertising, and consumer logistics backbone. For so long, the company has been defined by its core e-commerce operation, selling books, electronics, and everything else delivered fast. That business, split into North America and international segments, is what everyone knows. The magic and the profit has long come from Amazon Web Services, or AWS, which rents computing power, storage, and a vast suite of sophisticated tools to everyone from startups to governments. It powers a huge portion of the internet. Then there's the advertising arm, which leverages the massive traffic to its retail site to sell sponsored product listings and video ads, a business that carries incredibly high margins. The tension has always been that the high-growth, high-profit AWS and ads businesses were funding the high-cost, low-profit retail expansion. What this quarter's report shows is that the retail business itself is becoming a much stronger profit center, just as the high-profit engines are re-accelerating. The sheer volume of trading today is indicative of a fundamental narrative shift. This isn't just retail traders on the Robinhood app chasing momentum, this is large-scale institutional reevaluation. Analysts at firms like Wedbush and Evercore ISI are out this morning with notes talking about a positive narrative shift and an AWS unlock. The consensus price target is already moving up toward $269. Before today, Amazon was the laggard, up only 1% or 2% on the year. With this single-day move, it is now on track to blow past the year-to-date performance of both Tesla stock and Apple stock. This is a major repositioning. This is why having a robust Fidelity trading platform or the detailed analytics from Interactive Brokers is so valuable. It allows you to see this institutional flow in real time. We're seeing Fidelity mutual funds and other large players who were likely underweight on AMZ now having to chase the stock higher. Looking ahead, the future outlook is now framed by this reacceleration. The company guided for fourth quarter revenue to be between $206 billion and $213 billion, another strong forecast pointing to a robust holiday season. Analysts are already modeling for AWS growth to continue at this new, faster 21 to 22% pace. The primary catalyst is clearly AI. The company is spending a fortune, raising its capital expenditure guide from $100 billion to $125 billion. But unlike before, investors can now see the return on that investment in the form of accelerating AWS and Trainium chip revenue. The continued rollout of AI-powered tools like Rufus in the e-commerce search bar and Curo for developers will be a key catalyst. The second major catalyst is margin expansion. As the FTC charge rolls off, the underlying profitability of the North America segment will become clearer, and the street will have to reprice the retail business accordingly. This is a story of online investment in its purest form, a thesis being tested and validated. Of course, no investment is without risk. The biggest risk remains the macroeconomic picture. If the consumer truly buckles under pressure, even Amazon's logistics machine will feel the pinch, as we saw some hints of in reports about price-sensitive consumers. The second risk is that massive $125 billion in spending. While it's now justified, it's still an enormous cash outlay, and any stumbles in execution could be punished. Finally, competition is not sleeping. Microsoft's Azure and Google's Cloud are also growing very fast, and this AI war is fantastically expensive. Regulatory pressure is also a constant, as the $2.5 billion settlement clearly demonstrates. These are factors any investor using a SoFi robo-advisor or managing their own individual brokerage account must keep in mind. You can't just buy and forget. You have to monitor the data. For those looking for investment help or to build an intelligent portfolio, understanding this balance of catalyst and risk is the whole game. This is especially true for those diversifying with Fidelity ETFs or